Hello everyone. Welcome to EPK Capital's Daily Brief video. I am your host, Sneha. In this series, we try and update you and make sense of all the important news from the world of finance that came out globally in last 24 hours. So, without further ado, let's begin. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details in description, or you can connect with your financial advice. As the trading week concluded on Friday, August 15th, 2025, global financial markets presented a fractured and complex picture. A closer look at the closing numbers reveals a story of divergence, particularly within the United States, where different segments of the economy are reacting to a shifting landscape of macroeconomic pressures and policy expectations. U.S. markets, a tale of two tapes. In the United States, the session ended with a clear split between the industrial-focused Dow Jones and the technology-heavy NASDAQ composite. The Dow Jones Industrial Average managed to eke out a gain, closing at 40,946, which was an increase of 34.86 points, or 0.08%. This resilience in so-called blue-chip stocks suggests that investors found relative safety in established, value-oriented companies. In stark contrast, the broader market indices faltered. The S&P 500 index, which had achieved a significant milestone earlier in the week by closing above 6,400 for the first time in history, ended the day in negative territory. It fell by 18.74 points, or 0.29%, to settle at 6,149.80. The tech-centric NASDAQ composite experienced an even steeper decline, shedding 87.69 points, or 0.40%, to close at 21,622.98. This divergence is a critical signal. It indicates that the market's concerns were not driven by broad-based panic, but were instead concentrated in specific sectors. The underperformance of the NASDAQ and, to a lesser extent, the S&P 500, points directly to weakness in technology and other high-growth stocks. These sectors are particularly sensitive to changes in interest rate expectations and inflation, which became a focal point of the day's trading narrative. Meanwhile, the CBOE Volatility Index, VIX, often referred to as the market's fear gauge, closed at a relatively subdued 15.1, suggesting that while there was clear sectoral rotation, widespread anxiety had not yet taken hold. European and Asian markets, a mixed global picture. Across the Atlantic, European markets also ended the week on a downbeat note. In the United Kingdom, the FTSE 100 index closed at 9,138.90, down 38.34 points from its previous close. Germany's DAX index saw a more modest decline, finishing at 24,359.30, a loss of 18.20 points, or about 0.07%. The story in Asia was more varied. Japan's Nikkei 225 index was a standout performer, surging by 729.05 points, a remarkable 1.71% gain, to close at 43,378.311.10. In India, markets were closed for the Independence Day holiday. The previous session on August 14th saw the benchmark Sensex index close at 80,597.66, a slight gain of 0.07%, which was significant as it marked the end of a 6-week losing streak for Indian equities. The macro pulse, trade tensions, and inflationary pressures. The divergent performance across global markets was not random. It was a direct response to a complex interplay of macroeconomic forces, chief among them being the escalating trade tensions initiated by the United States and the persistent threat of inflation. The market is currently grappling with the ripple effects of recently implemented U.S. tariffs and the uncertainty surrounding future trade policy, which has created significant headwinds for global growth. The three-pronged impact of U.S. tariff policy analysis from leading financial institutions suggests that the rise in U.S. effective tariff rates is impacting the global economy through three primary channels. First, the unwinding of front-loading activity is creating a drag on growth. In the months leading up to the implementation of tariffs, many businesses accelerated their purchasing and shipping schedules to build up inventories, artificially boosting economic activity. That effect is now not only fading, but reversing, as companies work through their stockpiles, leading to a slowdown in new orders and industrial production. Second, the tariffs are functioning as a direct tax increase on U.S. businesses and consumers. This policy raises costs for businesses that rely on imported goods and squeezes the purchasing power of households as those higher costs are passed on. This acts as a significant brake on economic growth, with its full effects expected to be felt throughout the second half of the year. Third, the ongoing trade disputes have delivered a severe sentiment shock to the global business community. What was once a positive outlook following the U.S. election has now turned decidedly negative. This depressed sentiment stifles capital investment and hiring decisions, as companies become more cautious in an unpredictable policy environment. Inflation data ignites market jitters. This challenging backdrop was exacerbated by recent economic data that reignited inflation fears. A hotter-than-expected Producer Price Index (PPI) report for July showed that inflationary pressures at the wholesale level were not cooling as anticipated. This data point was a critical catalyst for the sell-off in growth and technology stocks, as it directly challenged the prevailing market narrative that falling inflation would allow the U.S. Federal Reserve to begin cutting interest rates soon. The market is now in a precarious position. Protectionist trade policies are directly contributing to the very inflation that makes it more difficult for the central bank to support the economy. Tariffs, by their nature, are inflationary. The costs are either absorbed by businesses, which hurts corporate profit margins, or passed on to consumers, which fuels headline inflation numbers. This creates a feedback loop where trade policy fuels inflation, which in turn ties the hands of the Federal Reserve, preventing it from deploying the monetary stimulus the market desires to offset the economic damage caused by the trade policy itself. Key economic data on the horizon. Looking ahead to the start of the new week on Monday, August 18th, several key economic data releases will provide further insight into the health of the global economy. Thailand's Q2 GDP. This release is highly anticipated, with forecasts suggesting a significant slowdown in quarter-over-quarter growth to just 0.30%, down from 0.70% in the first quarter. This aligns with broader concerns about slowing growth in Asia, as economies that are heavily reliant on manufacturing and exports feel the impact of the global trade slowdown. And Singapore's non-oil domestic exports, NODX. Following a surprisingly strong 13.0% year-over-year expansion in June, the July data will be closely watched to see if Singapore's trade sector can maintain its momentum amidst the challenging global environment. U.S. NAHB Housing Market Index. This report will offer a timely snapshot of sentiment among U.S. homebuilders, providing a key read on the health of the American housing market. Central bank focus, the road to Jackson Hole in a pivotal regulatory shift. With the macroeconomic picture clouded by uncertainty, the focus of the market has shifted squarely to the world's central banks, particularly the U.S. Federal Reserve. Two major developments have captured investors' attention: the intense anticipation for the upcoming Jackson Hole Economic Symposium, and a landmark, yet subtle policy shift regarding the supervision of cryptocurrency activities within the banking sector. All eyes on Jackson Hole. The annual Jackson Hole Economic Policy Symposium, hosted by the Kansas City Fed, is scheduled for August 21, 2023. This event has historically been a platform for major policy announcements, and this year is no exception. The market is laser-focused on the keynote address to be delivered by Federal Reserve Chair Jerome H. Powell on Friday, August 22nd. The theme for this year's symposium is Labor Markets in Transition, Demographics, Productivity, and Macroeconomic Policy, a topic that gives Chair Powell wide latitude to comment on the full spectrum of economic conditions. Investors will be parsing his every word for clues about the future path of monetary policy. Following the recent strong inflation data, the market's conviction about a near-term interest rate cut has been shaken. Powell's speech is now seen as a decisive moment that could either confirm the likelihood of a September rate cut or signal a more hawkish, higher-for-longer stance on interest rates. The Fed's landmark pivot on crypto supervision. While the market looked ahead to Jackson Hole, the Federal Reserve made a significant announcement on Friday, August 15th, that could have profound long-term implications for the digital asset industry. The Fed declared that it will sunset its Novel Activities Supervision Program. This program was established in 2023, in the turbulent aftermath of the collapse of the FTX crypto exchange and the subsequent failures of crypto-exposed lenders like Signature Bank and Silvergate Bank. Its creation effectively placed crypto and fintech-related banking activities into a separate, high-scrutiny regulatory category, signaling to the financial industry that these were considered exceptionally risky endeavors. In its announcement, the Fed stated that since the program's inception, it has strengthened its understanding of those activities, related risks, and bank risk management practices. Consequently, the supervision of these activities will now be integrated back into the normal supervisory process, and the 2023 letter that created the specialized program will be rescinded. This move represents a major evolution in the regulatory posture towards digital assets. By claiming to have developed a sufficient understanding of the risks, the Fed is signaling a new level of confidence and maturity in its approach. Integrating crypto supervision into standard processes implicitly suggests that these activities are no longer novel in the sense of being unknown or unmanageable. Instead, they are becoming a recognized part of the broader financial landscape that can be handled within existing, well-understood regulatory frameworks. This is a subtle but powerful act of legitimization. For large, conservative financial institutions, this reduction in regulatory ambiguity is a critical step, removing a significant barrier to entry and paving the way for more predictable compliance and greater institutional adoption of digital assets in the years to come. The digital frontier, Bitcoin's volatile peak and Ethereum's ascent. The cryptocurrency market experienced a week of dramatic and divergent action, defined by a record-breaking surge and subsequent crash for Bitcoin, and a powerful, sustained rally for Ethereum. These movements highlight a growing bifurcation in the digital asset space, where different assets are responding to different primary catalysts. Bitcoin's macro-driven roller coaster. Bitcoin began the week with a powerful rally, surging to a new all-time high of around $124,000 on August 14th. This upward momentum was driven by a confluence of factors that pointed towards greater mainstream and institutional acceptance. These included strong, consistent inflows into spot Bitcoin ETFs, favorable regulatory developments from the U.S. administration, such as the Genius Act, and new rules allowing for crypto investments in 401k retirement accounts, and a widespread market expectation that the Federal Reserve was on the cusp of cutting interest rates. However, this bullish narrative came to an abrupt halt. The rally's trigger was hope for looser monetary policy, and its undoing was data that contradicted that hope. The hotter-than-expected Producer Price Index, PPI, report served as a cold shower for the market, immediately dampening expectations for a September rate cut. The reaction was swift and brutal. The price of Bitcoin plummeted, falling below $119,000. The sell-off triggered a massive deleveraging event across the market. In a 24-hour period, over $1 billion in leveraged long positions were liquidated, wiping out traders who had bet on a continued price rise. The selling pressure was compounded by significant outflows from spot Bitcoin ETFs, which saw a net withdrawal of $292.9 million. This price action demonstrates that Bitcoin is now trading as a mature macro asset, highly sensitive to inflation data and Federal Reserve policy expectations. Analysts are now closely watching key support levels in the $110,000 to $112,000 range to determine if the bullish structure can be maintained. Ethereum's ETF-fueled surge. While Bitcoin was whipsawed by macroeconomic news, Ethereum charted a different course. The world's second-largest cryptocurrency has been on a powerful upward trend, climbing to its highest levels since 2021 and trading in the $4,500 to $4,700 range. Over the past month, Ethereum has surged by more than 50%, dramatically outperforming both Bitcoin and the broader crypto market. The primary driver of this exceptional performance is a single, powerful, product-specific catalyst: the launch and overwhelming success of spot Ethereum ETFs. These new financial products have unlocked a torrent of institutional capital. On August 11th alone, Ethereum ETFs saw a record-breaking $1.02 billion in net inflows, with BlackRock's IBIT fund leading the charge. These inflows have continued at a historic pace, dwarfing those seen for Bitcoin ETFs at a similar stage of their launch. This dynamic has created a clear divergence in the market. While Bitcoin's price is being dictated by the broader macro narrative, Ethereum's is being driven by immense and relatively inelastic buying pressure from ETF issuers who must acquire the underlying asset to meet investor demand. This structural inflow has, for now, overpowered the negative sentiment from inflation data and is fueling a narrative of a potential shift in market leadership, with Ethereum's market dominance growing at the expense of Bitcoin's. Analysts are now looking for a potential break of Ethereum's all-time high of around $4,800, which could open the door to price targets in the $5,500 to $6,000 range by the end of August. In other crypto news, Do Kwon, the founder of the collapsed Terra Luna ecosystem, has pleaded guilty to fraud charges, and asset manager Grayscale has filed for a spot Dogecoin ETF, signaling continued interest in expanding crypto-based financial products. The week ahead, key data and events on the horizon. As we move into the week of August 18, 2025, markets will be navigating a dense calendar of economic data releases and pivotal central bank communications. The core tension remains between the dampening effects of trade policy and inflation, and the powerful, specific catalysts driving certain market segments. The signals that emerge in the coming days, particularly from the Federal Reserve, will be crucial in determining the market's direction. Beyond Monday, the week is packed with market-moving events. The release of the FOMC meeting minutes on Wednesday will offer a more detailed look into the Fed's July deliberations. On Thursday, the U.S. flash PMI data will provide the first major glimpse into economic activity following the latest round of tariffs. Finally, the Jackson Hole Economic Symposium will run from Thursday to Saturday, culminating in Chair Powell's highly anticipated speech on Friday, which has the potential to reshape market expectations for the remainder of the year. Inflation data from the UK, Japan, and the Eurozone will also be released throughout the week, ensuring that the theme of global price pressures remains front and center. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget to subscribe to our channel for such wonderful daily content. You can also follow us on Instagram and Twitter. The details are in the description. For more information or for your personal financial advice, kindly connect with us on the details given in description. I will see you in the next video. Thanks for watching.